Thank you for joining Baker Tilly and MHA MacIntyre Hudson on today's webinar, Understanding New UK Hybrid Mismatch Rules.
Okay, so the first slide is just by way of a reminder, really, in connection with the OECD's Base Erosion and Profit Shifting Initiative, which seeks to close gaps in international taxation for companies that use international tax structuring for perceived avoidance purposes. As you will recall, the OECD issued 15 action items, as listed here, to address the main areas where they feel companies have been most aggressively shifting profits. I think it's fair to say the UK has been actively responding to the OECD's recommendations and has already legislated in a number of areas. So if we could just move to the next slide, please. Okay, so jumping the gun somewhat, the UK introduced diverted profits tax back in 2015 in response to Action 7 and 9. So known as the Google tax, these rules apply where a non-UK company avoids the creation of a PE, a permanent establishment, or where a UK company diverts profits from the UK using an arrangement that lacks economic substance. The legislation is now starting to bite, with Diageo being one of the first multinationals to face a DPT claim from HMRC of £107 million. Whilst this legislation is aimed at large groups, the thresholds, as you can see, are relatively low, so it will impact a large number of companies potentially. Again, in response to Action 7, the UK introduced new withholding tax rules in June 2016. These rules result in a general widening of the definition of the type of payment that can suffer UK withholding tax, which previously only applied to patent royalties, but now includes a wider range of intangibles, such as trademarks and brand names. The new rules also include specific anti-avoidance rules impacting non-UK companies with an avoided PE under the UK DPT provisions. The hybrid mismatch rules were introduced in January 2017 in response to Action 2, and we'll go through these in more detail shortly. And in response to Action 4, the UK is introducing corporate interest restriction legislation. These rules will be effective from 1st of April 2017 and will limit corporates to a fixed ratio deduction for interest of 30% of a group's UK tax EBITDA. Clearly, some industries are highly geared, so for highly leveraged groups, it will be possible to elect to use a group ratio. Given the low interest rates currently, certainly in the UK, there is a relatively high threshold of £2 million of net UK interest expense before these rules apply, but they are extremely complex and will need to be considered very carefully where significant debt is being introduced into the UK. And not mentioned on the slide, the UK is also legislated in a number of other areas, including implementing the OECD's revised transfer pricing guidelines into our legislation and country-by-country reporting. So if we can move to the next slide, please.
Hey, Chris, just real quick, just a couple reactions from a U.S. perspective as to those particular BEPS actions that are the focus of discussion here today, and more so Action 4. But quickly on Action 7, the U.S. is waiting to see how the OECD's work on profit attribution progresses before deciding how to move forward on the permanent establishment issue. There is interest in this particular action item by the U.S., and a report was just most recently released in the summer on profit attribution. So the U.S. is interested in that particular action item and looking at it. More specifically on Action 2, the focus here, the U.S. generally believes that its tax law, for example, are dual consolidated loss rules, and we'll see an example where they might apply later in this presentation, and treaties generally embody a number of the recommendations in Action 2. On last check, there were no active U.S. legislative proposals on Action 2. And then on Action 4, more specifically, current U.S. thin capitalization rules provide a fixed ratio limit on the deductibility of net interest expense as applied to related party debt. That ratio from a U.S. perspective is set at 50% instead of the 10 to 30% limit recommended under the action, the 30% here in the given case with the new UK legislation. And on last check, again, as with Action 2, there's no active U.S. legislative proposals on Action 4. While neither Action 2 nor Action 4, while neither in Action 2 or Action 4 response by the U.S., there are new 385 regulations under review by the current administration which could fundamentally change the debt v. equity analysis for U.S. issuers and result in more stringent documentation requirements in support of debt treatment for U.S. tax purposes.
Okay, thanks, Jim. Okay, so just moving, sorry, can we just go back a slide? Okay, so just quickly touching on the EU Anti-Tax Avoidance Directive. So again, this follows the OECD's recommendations, and the EU formally adopted the Anti-Tax Avoidance Directive in June 2016. The directive contains 5 legally binding anti-abuse measures, which all member states need to apply with effect from 1st of January 2019. These being a general anti-abuse rule, or GAR, interest limitation rules, exit taxation, CFC rules, and a switchover rule. So in the UK, we've had a GAR since 2013, although I'm not aware of any cases or taxpayers that have been subject to a GAR claim from HMRC to date. We also have exit charges on assets leaving the UK or companies becoming non-resident. As the UK adopts a territorial approach to taxation, we now have a relatively relaxed CFC regime. However, the Treasury believe it's effective for the purposes of the directive. And as I just said, we're introducing interest limitation rules this year. The switchover rule includes a credit system for certain types of foreign income instead of an exemption, which can be taxable if originating from a member state with a lower tax rate. This goes against the UK's territorial approach, so it's unlikely to be introduced into UK legislation, particularly as the UK will surely have will no longer be a member of the EU, so on the face of it won't have an obligation to comply with the directive. This is obviously subject to the terms of the Brexit deal, which, as we're all aware, is currently being negotiated, or not, as the case may be. Jim, just on the subject of Brexit and in the context of the UK-US treaty, have you got any observations or comments there?
No, I mean, as it stands right now, obviously it's going to impact how structures are globally integrated from a standpoint of intermediary UK entities as part of a global structure and in regards to whether we're valuing of things as to incidents of taxation in the chain as it relates to relief provided under EU directives and the like that may or may not be there now. Vis-a-vis from a U.S. perspective, we generally still have existing bilateral agreement in place, treaty in place between the U.S. and U.K., and it'd be interesting to see how any renegotiations might come out as a result of that. I think as a general matter, we see instances of that I think some of the things that the UK has enjoyed in the EU, being a member of the EU, may through some like compensation still exist on a post-Brexit, as that continues to be an ongoing negotiation. But I think there is some aspects to wait and see. But clearly, this could have an impact as to overall how it overall integrates into global structures for our U.S. multinationals. To this polling question, I'd be interested in either Chris or Allison's thoughts around the treatment of U.S. LLCs in particular as we go into this dialogue and talk about hybrid entities. One such hybrid entity could in fact be a U.S. LLC. So even in the absence of a so-called check-the-box election, for U.S. purposes, could have a default disregarded entity status. The UK's longstanding position has been to treat U.S. LLCs as corporations for UK tax. Perhaps the door has been opened a little bit as a result of an earlier decision in Anson v. Commissioners, which basically said that analysis really turns on the facts and circumstances. So I'd be interested to know, and in conjunction with how the new legislation is now implemented in the UK, what are the HMRC's views more specifically on treatment of U.S. LLCs? Is it still a facts and circumstances type analysis, or is that overly narrow? And HMRC is still sticking to the general default position that LLCs be treated as corporations for UK tax. Chris, Allison?
Yeah, well, as you say, Jim, the Anson case, which went all the way to the Supreme Court, was really at odds with HMRC's established practice on LLCs. So historically, they'd always contended that Mr. Anson, for example, had received a distribution from the LLC because it's viewed as an entity in the UK, and as such, no double tax relief was due. because US tax was charged on a share of the profit rather than on a distribution. So the Supreme Court agreed with Mr Anson that the profits belonged to the members as they arose, and hence Anson was taxed on the same profits in the UK as had been taxed in the US, and consequently that double tax relief was due. So following the results of that case, HMRC issued an announcement, as you said, saying that the facts were very specific to that case, and it would continue its previous approach to LLC income, and where individuals claim double tax relief on Anson-style income, they will consider the facts on a case-by-case basis. Now, not a lot has actually changed since then. From an advisor's perspective, we're shifting towards claiming relief first and then waiting to see if HMRC challenge the position. But as a result of the uncertainty, it's also possible to obtain an opinion from HMRC on their view of the treatment of future LLC income, where an LLC is to be used in a structure. But in our experience, to be honest, most taxpayers are choosing not to go to HMRC first, but to see if they're challenged. So I'm afraid there's still uncertainty from our perspective, and I don't think there's anything that's in any of the current amendments that would change that point of view.
Thank you for those thoughts, Alison. Yeah, it's clearly U.S. LLCs are a favorite of within the legal community here in the U.S. and structuring for inbound investment into the U.S. So it might give some pause with some layer of uncertainty there as to whether that is the appropriate choice of entity coming into the U.S. Or perhaps some type of alternative form, limited partnerships or the like that may accomplish similar type results.
Okay, so let's move on and get into the meat of this and look at the hybrid mismatch rules in a bit more detail. So, as I've already said, these rules have been introduced in response to Action 2 of the BEPS review, and the legislation was included in the 2016 Finance Act and is effective from the 1st of January this year. The legislation itself runs to 40-odd pages, and to put its complexity into perspective, HMRC also published their guidance in December 2016 as to how they think the rules should apply, which runs to some 404 pages. So I think it's fair to say, whilst most of the BEPS review focused on the way in which large multinational organisations structure their tax affairs, it's important to note that there is no de minimis threshold as to when the hybrid mismatch rules can apply. And most UK anti-avoidance provisions need to be considered in light of the commercial motives behind a particular structure or arrangements. However, there's no motive test when looking at these rules. And whilst they do contain a reasonable to suppose test, taxpayers are likely to find themselves either in or out with not much room for interpretation in between. The UK is one of the first territories to introduce hybrid mismatch rules, and the legislation recognises that other territories will be bringing in similar provisions. So broadly, adjustments are unlikely to be required where the structure or arrangements in question concern another territory which has enacted similar provisions as recommended in the OECD's report published in October 2015. And the EU itself has adopted its own anti-hybrid directive in February 2017, and EU member states will be required to implement most of these provisions by 1st of January 2020. So what do the rules apply to? They apply to arrangements between related parties that involve both a hybrid instrument or hybrid entity and a tax mismatch caused by the hybrid. Where applicable, the rules operate to counteract the tax mismatch by making corporation tax adjustments in the entity subject to UK corporation tax, either by disallowing a deduction, for example for interest, or in certain circumstances including an amount as ordinary income. The rules can clearly apply where the relevant UK entity is directly involved in the hybrid mismatch, but can also apply where the entity is part of a wider arrangement and the mismatch arises somewhere else in the group. This can be considered an imported mismatch, and Alison will take us through an example of this shortly. If we could just move on to the next slide, please. So in practice, the rules will need to be considered in all multinational groups where there are payments or quasi-payments in connection with financial instruments, hybrid transfers, hybrid entities, companies with permanent establishments, and dual resident companies. As a practical matter, a good starting point is to identify a mismatch in the tax treatment within an arrangement. In order to do this, it will be necessary to fully understand the corresponding overseas tax treatment to each transaction. If there is a mismatch, this can then be tested to see if it's of a type which is within the scope of the hybrid mismatch rules. The rules are mechanical in operation, and as already noted, do not contain a motive test. So it can apply, and this is important to note, they can apply to wholly commercial transactions and to all types of deductions, including interest, intragroup fees, and payments for goods and services. From a UK compliance perspective, these rules will be subject to self-assessment, so a group will need to self-determine whether they apply when preparing their corporation tax returns. And due to the potential impact on UK tax liabilities, they will also need to be considered when the tax accounting provisions and disclosures are made, for example, under FIN 48. So the legislation and guidance includes definitions of the key terms, such as ordinary income, relevant assumptions, payee, payments, quasi-payments, and so on, which we've not got time to go through in detail today. But for the purposes of going through the examples, understanding the following key terms I think are important. So a payment is broadly any transfer of money or money's worth in relation to which an allowable deduction arises in calculating the taxable profits of the payer for a taxable period. An amount is a quasi-payment if an allowable deduction would arise in calculating the taxable profits of the payer for a taxable period, and the circumstances giving rise to the deduction may reasonably be expected to result in ordinary income of one or more persons. So this could be where an accrual is deductible in respect of an instrument, but no amount is brought into tax by the counterparty, which could happen with some convertible debt instruments, for example. So a tax mismatch means that the relevant payment or quasi-payment is either not included as the ordinary income of another entity and be subject to tax in that entity. These are known as deduction stroke non-inclusion mismatches, or give rise to a double deduction. And an entity is a hybrid entity if it's treated as a taxable person in one territory but differently in another territory. So, for example, a disregarded UK subsidiary of a US parent will be treated as a company for UK tax purposes but ignored for US tax purposes. LLPs are another good example where they're treated as transparent in some territories, such as the UK, but opaque in others. And finally, in terms of wrapping up the summary, it's worth noting that certain payments are treated as permitted and hence do not give rise to deduction stroke non-inclusion mismatches. The permitted payments are those made to entities that are resident in a tax haven and not subject to tax, entities that are resident in a jurisdiction that does not tax income from foreign sources, entities such as pension funds which enjoy general exemption from tax, authorised investment funds or offshore funds which are treated as widely held, and entities with sovereign immunity from tax, or sovereign wealth funds held at least 75% by a sovereign body. So I think it's worth just running back up the list there in terms of tax havens. So we've got some legislation that's there to attack avoidance, but you can still transact with a tax haven, which seems at odds with this particular piece of legislation. But it's there purely to attack hybrid situations. So it's there to attack tax advantages that derive from the hybridity of either an instrument or an entity. So on that note, can I hand you back to Alison to run through some examples of where the rules can apply in practice?
Thank you, Chris. If we could move on the slide, please. So let's look at a few of the more common examples that companies and groups are likely to face. Our first relatively simple example looks at hybrid instruments. That is where there's a mismatch between the tax treatment of payments and receipts on a financial instrument. So the rules relating to hybrid instruments are contained within Chapter 3 of the legislation. And for counteraction, for there to be an adjustment to apply, 4 conditions need to be satisfied. So condition A requires a payment or quasi-payment to be made under or in connection with a financial instrument. Condition B requires that either the taxpayer or the payee is within the scope of UK corporation tax. Condition C requires that it's reasonable to suppose there is a mismatch in relation to a transaction, and condition D requires that the two companies are related or the financial instrument is a structured arrangement. So in the example shown, let's assume that parent has made a loan that's subordinated to the creditors of UK Co, and which is treated as an equity instrument in country X, being the parent's place of residence, and that UK Co pays a coupon on the loan to parent. So as the UK treats the transaction as a loan arrangement, the interest payments to parents are tax deductible by the UK company. However, as the loan is treated as a quasi-equity in the parent, the interest payments are treated as dividends, which are exempt under some form of participation exemption. Consequently, there's a mismatch in the tax treatment, and as the UK is the payer jurisdiction, the UK will, under the legislation, deny the deduction. And it's probably worth pointing out here that if the UK is the payee jurisdiction, then HMRC wouldn't take notice and seek to counteract if the mismatch had already been countered in the payer jurisdiction, or failing that, the UK will tax the payee company on an amount equal to the mismatch. So other circumstances that could be captured under Chapter 3 would include things like the release of a debt, deemed interest arrangements, and circumstances where the payee has no tax jurisdiction. So if we could just move on, please.
Alison, hold that slide for a second, if you would, please.
Yeah.
You go back, Lindsay. So, in this example, we saw some characterization here from, debt v. equity, both from a UK perspective and then a parent company perspective. In which one case, the UK saw that as a debt instrument with the new hybrid mismatch rules with interest deductibility. On the other hand, the parent company then receiving a dividend. And then Alison also mentioned the idea that normally that dividend may not, in fact, be actually taxable to parent in country X here through application of some type of participation exemption. And then query on the heels of Brexit, going back to Chris's earlier point, how, that might be taxed at parent level on the heels of the UK leaving the EU and availing itself, as discussed earlier, in certain of those EU directives. Separately, aside from the country X and the UK analysis here, assume for the moment that, parent country X falls within a broader U.S. group structure. A separate analysis will need to be given as to the characterization of that instrument from a U.S. tax perspective as well. That analysis, would, among other things, inform whether the payment by UK Co. is deductible interest payment or non-deductible dividend to foreign Co. And then in turn, characterizing the related payment would also inform an analysis surrounding the availability of deferral of that income to foreign Co. For U.S. tax purposes and overlaying our Subpart F rules. So what should be clear here as a result of this legislation, the inner workings of Brexit, and part of an overall integrated structure, it's a multi-pronged type of analysis as to the fallout of transactions like this on the heels of these changes. Thank you, Alison.
Thank you. Thanks, Jim. So our second example looks at hybrid entities, that is, entities that are regarded as taxable in one territory but are transparent in another. So hybrid entities, as we've already heard, will include partnerships, UK LLPs, US LLCs, and various other forms of entities that may or may not be fiscally transparent. So the legislation relating to hybrid entities is contained within Chapters 5, 7 and 9 of the legislation. Chapter 5 deals with hybrid payers, Chapter 7 with hybrid payees, and Chapter 9 with the hybrid entity double deduction. So in this simplistic example, therefore, if the UK company is the hybrid entity, as it's a disregard entity for US tax purposes, So the UK company pays interest to the US company under a loan arrangement, and without these rules would obtain a tax deduction in the UK. The US parent, on the other hand, doesn't recognise the interest income, as it would effectively be recognising as income a payment that it made to itself. So consequently, as a result of the new rules, the UK will deny a tax deduction for the UK interest payments. Can we move on, please? Thanks. So to take that to the next level and look at a slightly more complex example, we'll focus our attention on the hybrid entity double deduction, which, as I previously mentioned, is covered by Chapter 9 of the legislation. So for Chapter 9 to be in point, 3 conditions need to be satisfied. Condition A requires that an amount has been deducted from the income of both the hybrid entity and the investor in the hybrid. Condition B is that either entity is within the scope of UK corporation tax. And condition C is that the entities are related or are part of a structured arrangement. So looking at our third example, the US parent company indirectly holds an operating company in the UK. Inserted between the US and the UK is another UK sub that is disregarded for US tax purposes, but which remains fully taxable in the UK. So UK sub 1 obtains a bank loan on which it pays interest. The US parent will receive a tax deduction for the interest paid by Subco 1, as Subco 1 is treated as transparent. But in contrast, Subco 1 is treated as a separate person for UK tax purposes, and so also receives a deduction. The UK operates a tax consolidation regime, and so also allows Subco 1 to surrender its losses to UK OpCo for tax purposes. The effect of the scheme, therefore, is that 2 deductions for the same interest payment arise in 2 different countries. Similar effects can also be achieved through different structures, for instance, through the use of a dual resident company instead of a hybrid entity, where the dual resident company has a loss and it can benefit from group relief tax consolidation systems in both countries. So in order to counteract the double deduction achieved in this example, Subco 1 will be denied a deduction for the interest payment in the UK. So Jim, over to you.
Yeah, so a couple one-on-one touch on your latter point there, which is kind of the deduction against 2 group type of systems, UK group relief and from a U.S. consolidated perspective. So this is one of the examples where the U.S. had thought that their own law is adequate on point, maybe doesn't get all the way there, and that's the application of our U.S. dual consolidated loss rules. So in this example, if Sub 1 UK then has the loss that then is group relieved against OpCo UK, US Co would be allowed that loss from what's referred to on a surly basis. But if you would imagine that US Co is in turn part of a broader US consolidated group, there would be limitations then on the ability to utilize that loss both against another member in the US group. So faced with that decision, obviously the US company would prefer benefiting that interest, that loss at higher U.S. rates on what would be deemed to be third-party bank interest expense for U.S. Co in this example, at higher U.S. marginal rates as opposed to lower marginal rates there in the U.K. So while not a perfect system, our dual consolidated loss rules do kind of operate to prevent too much of an abuse here within in situations like this. And then separately, obviously, it's not, and we don't know what the facts in this particular case are, but it's Sub 1 UK. If all it was a holding company and had the interest expense that then was on group relieved on as a loss down to OpCo, how is it then funding that interest expense? So that would raise funding questions as to whether OpCo UK itself is actually pushing up dividends to fund that, in which case it would flow through up into the U.S. and kind of negate some of that double tax deduction aspect and bringing dividend income back up to the U.S. at higher marginal rates as well. So that's an example of kind of understanding in an integrated structure how that might work, and it may not be as clear on its face, and kind of working through those dual consolidated loss rules in a given case here for U.S. purposes. Building on the earlier discussion on the earlier example that Allison gave was the deduction no income scenario. And, that's a very common structure for most of our closely held type of middle market companies that operate in private limiteds for which check-the-box elections have been filed to treat as fiscally transparent for U.S. tax purposes. This is a traditional structuring for U.S. flow-through investment into the U.K. It might now require a rethink in light of this new U.K. legislation, and taken together with each the potential for U.S. shareholder taxation at lower capital gains rates, and keeping instead in corporate solution on certain qualified dividend income distributed out by the U.K. subs, and taken together as well with declining U.K. corporate tax rates. So perhaps corporation treatment for each U.K. and U.S. tax purposes is not that bad a thing. Additionally, while perhaps not yet clear, I'd be curious to see what the U.S. response might be in examples like that, where while in the deduction no income scenario and operating in a disregarded entity in the U.K. is generally more tax neutral from a U.S. federal taxable income perspective, exchange gain or loss on remittances aside. The result here is that more tax is being paid over to the U.K. government and less residual top-off tax to the U.S. government through potential foreign tax credit claims in the U.S. The U.S. has taken a more aggressive stance in certain voluntary tax scenarios and denying foreign tax credit on overstated branch profits. And it might think it appropriate here that an arm's length interest charge be borne by the U.K. branch. Kind of akin to the attribution of profits, some of the things we discussed about earlier, and being expenses appropriately borne by that U.K. branch. Allison, do you have any comments on that in particular? Or?
Yeah, I think that's very possible. From a treaty perspective, we don't see any of this legislation will particularly impact on our treaty position, but yeah, it'll be interesting to see the effects, as you say, in a number of other jurisdictions, because obviously this applies to UK companies' dealings on a worldwide basis. There will be potential losses of tax in those overseas jurisdictions. So, we wait with interest to see how overseas governments respond to that.
Yeah, and I think absent any sort of treaty relief, I think it's an example where these rules are, sweeping to the extent that they can apply in what you might argue are arm's length situations. Say, for example, from a transfer pricing perspective, they're very, very mechanical in their application.
Yeah.
We've seen examples where interest paid by a UK disregarded entity of a U.S. tax owner might be denied. Again, we talked about real quickly the existence of potential bilateral treaty relief and from an attribution of business profits perspective and determining the business profits attributable to the UK permanent establishment. These are examples of that might illustrate the potential need for a more detailed treaty analysis and if any relief might be available. Understanding that actual relief will turn on the particular facts. Chris, Allison, any further thoughts on? I'd be interested on whether you indicated the legislation vis-a-vis the treaty. So, and to make clear for our audience, from a U.S. perspective, we kind of embrace the last-in-time rule. So if U.S. legislation was to come in later in time, it could present the opportunity that the certainty around certain treaty relief could be undermined by a later in time change in legislation, taken together with Brexit and the potential for renegotiation of treaty. Anything further on that point as to the influence of Brexit perhaps, or application of whether in a given situation the UK may give equal weighting to a treaty relative to a later time change in legislation.
Yeah, I mean, again, I guess that's unclear. I mean, certainly the Treasury's view in relation to the hybrid mismatch rules, for example, is that the rules won't interfere with the UK's current treaty network at all. So, that's the view they're taking, and clearly some analysis, perhaps as you suggested, needs to be done to test that. I think in the context of Brexit, as we said earlier, clearly there's uncertainty around Brexit. There's probably more uncertainty given May's speech last week, where we finally, or the current government's finally accepted that we're going to have a transitional period. So we could have another 4 years where the status quo broadly remains the same in terms of UK and Europe. But certainly things will change going forward. I mean, the OECD BEPS review has been a clear driver in terms of forming the UK's tax policy, probably more so than the EU have in the past, and certainly the UK has been way ahead of the game in implementing some of the recommendations. I think the EU's ATAD directive followed some of the rules that the UK had already brought into play. So the UK is very much ahead of the game in that context. So I'm not sure if that answers your question, Jim, but just a few thoughts around the sort of treaty and Brexit overlay.
Yeah, of course. So Chris mentioned earlier imported mismatches, and it's really important to note that the hybrid rules can catch instances where the UK isn't directly a party to the eventual mismatch. So Chapter 11 of the regulation sets out the concept of the imported mismatch rules. And in short, they deem that the UK will restrict or deny a corporation tax deduction if the UK corporate taxpayer makes a payment that does not in itself give rise to a mismatch, but where there is within a wider arrangement a mismatch along the lines that we've been discussing. So to look at this example, a UK resident company, UKCo, makes royalty payments to another group company, which in our example is a Dutch BV. The royalty payments are fully taxable in the BV, but as part of a wider arrangement, the BV then makes royalty payments to a Dutch CV, which reduces its profits. So the CV is transparent for tax purposes in the Netherlands, as it's viewed as a partnership, but in the US, it's treated as a separate taxable entity as a result of the check-the-box rules. So accordingly, neither the US nor the Netherlands imposes tax on the royalty income in the CV. So although the payments from the UK company are fully taxable in the BV, the wider arrangement includes a hybrid entity mismatch, and under the imported mismatch rules, it's likely that the UK would deny tax deductions for the UK company's royalty payments to the extent that they fund the BV's onward payments.
Yeah,
Jim, I don't know if you've got any comments on that?
Yeah, I do. It should be clear from this example, again, that there's a need for a fully integrated analysis for each of direct and indirect transactions here as spans the group's overall supply chain and geographies in which it operates. We want to make sure that we optimize benefits and avoid unintended consequences, right? This both from a U.S. and the local country tax perspective, as this informs the overall group global effective tax rate and accounting for any uncertain tax positions for our U.S. filers of consolidated financial statements. The example shows items of income and deduction is transacted amongst group members, which, despite the potential for denied deductions under the new UK legislation, would still need to be factored into the calculation of earnings and profits for affected foreign subsidiaries of the U.S. investor we have here. One potential area for further analysis in examples like these may be to determine the existence of any splitting event under U.S. tax regulations, which might work to limit the U.S. multinationals' ability to claim a credit for any foreign taxes paid. Obviously, the involvement of a transfer pricing specialist can be critical to the implementation, documentation, and defense of any planning the type set out in this example.
Yeah. Actually, from a practical perspective in the UK, It's not always going to be clear to the UK company what happens further up the chain. So there's some real practical implications that, companies over here are going to have to consider.
Yeah, and I think it goes back to a point I made earlier about when you need to consider these rules. As we said at the outset, that there's no de minimis and there's no motive test. So, I think our view is that where you have a multinational situation, i.e. any cross-border that involves the UK, you're going to have to think about the application of these rules, certainly for tax purposes and as I mentioned, for accounting purposes when you're looking at tax provision and accounts disclosure.
Yeah, that's it. Let me piggyback again off of that. So it's an interesting comment that you always don't have a complete visibility as to the end-to-end taxation. One could assume that if there's income that goes without current taxation on the payment upstream of the royalty to Dutch CV, which is fiscally transparent for Netherlands purposes, but a reverse hybrid for U.S. purposes. So the idea here would be those earnings would in effect escape Dutch taxation and be deferred from a U.S. perspective. But we really don't know that to be the case, right? So it goes to the visibility that Alice is not kind of raised there. What if instead the royalty income up to Dutch CV then related in subpart F income and how it was carried out, for example, as to a potential cheer up into the U.S. tax return, in which case you would have full taxation at higher U.S. marginal rates.
Yeah. Okay. So finally, our final example. I think it's important to reiterate, as we've said a number of times, that the rules aren't restricted to financial instruments or to purely contrived arrangements, as many people think, but they do cover all forms of receipts and payments. So the example we have here is a practical example that could easily be missed. So as you see, we have a US parent with two UK subs, one an operating company and the other a service company, which incurs third-party costs, which are then recharged to the operating company. So both UK companies are disregarded from a US perspective. As such, payments between the two subs cancel out in the UK and are ignored in the US. However, the UK service company obtains a tax deduction for third-party costs it incurs, and the US parent also obtains a deduction for the same costs by reason of the service company being a disregard entity. So again, in these circumstances, HMRC would seek to deny the deduction to the UK service company. So Jim, any thoughts on that before we move on and sort of summarise?
Yeah, in this example, it's more of a relatively cleaner example from a U.S. perspective because we have flow through into the U.S. with both UK OpCo and UK ServCo. So the end result here is U.S. is going to pick up the income and corresponding deductions. So in the absence of any, it makes more important foreign tax credit utilization in the U.S. As a result of denials in this example. But with proper planning around foreign tax credit utilization would be something that's manageable. And then two, here's another example that kind of brings about that earlier question of whether expenses should be appropriately borne within this given structure from an attribution of profit perspective to the UK permanent establishment.
Yeah.
Okay. So if we just can move on a slide and just a very quick wrap up from my perspective of the implications. As hopefully you'll appreciate by now, the hybrid mismatch rules are incredibly complicated and can arise in many different circumstances, certainly far too many for us to have time to go through now. But what is clear is the review of all relevant structures is necessary to identify where the rules may kick in and consequently the effect on the group's overall effective tax rate. Most multinational groups and private equity financing structures will face the same challenges when structuring using hybrids and will undoubtedly reconsider now how they approach it in future. And it may be that similar advantages could be obtained from using benefits of low tax jurisdictions. As Chris mentioned earlier, they're not specifically caught by these rules, but obviously that's a separate topic and certainly not one that we've got time for at the moment. But as Chris has also said earlier, from a practical perspective, companies may need to consider their accounting provisions and disclosures to ensure that the implications of the rules are adequately reflected. And I suppose my final thought is, whilst there is a need to act quickly, again, as Chris said earlier, the UK is one of the first territories to introduce hybrid mismatch rules, and the legislation recognises that other territories will be bringing in similar provisions. That being the case, adjustments are unlikely to be required where the structure or the arrangements in question concern another territory which has enacted similar provisions. But in the meantime, these rules will definitely need to be kept in the front of multinational groups' minds.
And just kind of recapping where we were, we started with a brief overview of the OECD's Base Erosion and Profit Shifting Initiative, which looks to address strategies that exploit gaps and mismatches in tax rules to artificially shift profits to low or no tax locations, and introduced the UK and EU response to date, with a particular emphasis on the new UK hybrid mismatch rules. We reviewed examples for the application of those new rules and commented on a need for a closer analysis of those rules in an integrated group structure, including that around treaty analysis, transfer pricing, debt v. equity analysis, earnings and profits and other attribute quantification, foreign tax credit utilization, and financial statement reporting considerations. For U.S. investors, underpinning a number of the examples provided is planning for the deferral of earnings from current U.S. taxation. Potential U.S. legislative tax reform, a territorial tax system, repatriation holiday, and or reduced U.S. corporate tax rates could influence continued maintenance or the potential unwind of similar structures or alternative planning as U.S. multinationals potentially look to unwind deferral of their offshore earnings. In anticipation of a repatriation event, consideration might start to be given to the current state of E&P and tax pools within a group structure from an overall readiness perspective. We are aware of instances where other jurisdictions are implementing countervailing measures in a way of an expatriation tax or like to prevent the potential bailout of earnings from their local economy. Thus, repatriation planning for our clients and prospects is not to be done in a vacuum, but instead in close collaboration with MHA and other Baker Tilly International member firms.
Well, I think just in general terms, I mean, I guess from anyone listening in, it sounds like the UK has appointed itself judge, jury, arbiter, and global policeman in the context of the hybrid mismatch rules, certainly in respect of imported mismatches. But I think that's probably a perception at the moment off the back of the fact that the UK is one of the first territories to introduce the rules, and ultimately other territories will be doing or introducing similar provisions. But I think on that, on that sort of note, it's clear the UK is being proactive in introducing legislation following BEPS, and I think in that context wants to be seen, certainly within the UK, wants to be seen to be ensuring that multinationals, in particular, are paying the right amount of tax. I think there's a lot of political rhetoric around the amount of tax that large corporates pay or not, as the case may be, and certainly where the government are being seen to introduce anti-avoidance type legislation. I think they see that as being a very politically positive move. But on the other hand, I think one could take the view that some of these measures are quite helpful. I mean, we have a low effective corporation tax rate. Clearly, the legislation that we're introducing is encouraging companies to recognise a fair, adequate level of profit in the UK. And the fact that we've got a lower rate and a lowering rate, hopefully it's encouraging people to move functions, activities and risks to the UK, and address one of the issues of profits, earnings and profits being exported from a territory. So I think on the face of it, whilst we've got this legislation in place, I think, there's still good underlying reasons as to why, the UK is a good place to do business. And as I say, I think our lower effective tax rates are going to continue to promote that going forward. And we have to weigh that against the background of the uncertainty, the considerable uncertainty we have with things like Brexit. So yeah, just a few thoughts there. Alison, anything else you wanted to add?
No, I don't, not really. I mean, what I would say actually from a practical perspective, as far as doing business in the UK is concerned, we are still talking to a lot of people who actually are very interested in re-headquartering in the UK from other jurisdictions. So, on a practical perspective, we're not actually seeing that the UK stance on sort of anti-avoidance or Brexit to a large degree is having a big impact at the moment.